Absolutely horrible demand at today's US Treasury bond auction. Why it might not mean what you think. So, today we had a 5 year TIPS auction, and the demand was horrible. As we can see, Andy Constant, veteran of Brevin Howard and Bridgewater, gave it a D plus in terms of demand, one of the lower ratings we have seen for a bond auction in the past 6 or 9 months. And of course, a tips auction is totally different. When you see weak demand at a tips auction, it signifies something totally different from weak demand at a normal bond auction. We'll do our best to explain. Remember, a TIPS is a Treasury inflation protected security. This is a special kind of bond where the principal actually adjusts with the consumer price index, that inflation index, that consumer price index inflation index. As inflation moves higher, your principal actually adjusts. What a TIPS is designed to do is give you a real yield on top of that. So, for example, let's say that I buy $1,000 of a 1 year TIPS bond. Let's say that over that 1 year, inflation is 3%. Well, my principal actually went from $1,000. They're going to return $1,030 because inflation was 3%. My interest payment is actually calculated on top of that adjusted principal. So, what we can see here, high yield 1.18%, that is that real yield. That is the yield over and above whatever inflation ends up being. And I think the most intuitive way to try to think about this, here in white, we have the 5 year yield minus the 5 year break even inflation rate, and it's inverted. And I think this is the best way to illustrate this in an intuitive way. So with a TIPS bond, again, it's different from a normal bond. If there is a ton of concern, if there is a huge amount of concern about inflation, well, you would want to buy this Treasury inflation protected security, a special inflation adjusted bond, right? That would, of course, push demand up. That would push the white line up. Well, as we can see, what that would result in is a lower real yield. Conversely, if there was very, very weak demand, you would actually see this go down. And what that means is a higher amount of real yield, right now 1.18%, a higher real yield is required in order to entice demand. What we could see with this auction, very, very weak, again, D plus from Andy, we can see it tailed by 1.2 basis points. That is notably above the 6 month average of 0.8 basis points. What that means is that a higher real yield was required in order to get the bond market to absorb the $26 billion of these 5 year tips. The bid to cover 2.51, that's right around the 6 month average. Primary dealers, buyer of last resort, they took down 13.5%. Direct bidders, firms bidding directly for their own portfolio, took down 24%. Indirect bidders, that is a proxy for that foreign and institutional central bank sort of demand. That came in at 62%, so notably below the 6 month average. And we can see the implied break even inflation rate of 2.4%. Now, remember, with a TIPS auction, if you see very, very weak demand, that is signifying that the bond market is not worried about inflation. Therefore, you actually require that real yield. Again, that real yield means above and beyond whatever inflation ends up being. That real yield will actually be higher because, again, the demand is weaker. If the bond market was really, really worried about inflation, you would see demand surge for these Treasury inflation protected securities, and that would push the real yield lower. Hopefully that makes intuitive sense. By the way, here are the results from the Treasury website for this 5 year tips. And I want to make a note that core CPI is running at 3.1%. Headline CPI, which again includes food and energy, which are more volatile, so they're excluded from core CPI, but they're included for the headline CPI in green. We have inflation basically at 3%. And in fact, if you look at gold, remember the way to think about gold is as an FX pair, gold dollar. What we are looking at here with gold is a surge in gold. The other way of saying that is a weakness in the dollar. Remember that if gold dollar is ripping higher, what that means is the inverse is dollar gold is dumping lower. And you don't see that if the market kind of writ large is not worried about inflation. And of course, we have core CPI at 3.1 and we have headline CPI at 2.9% and very, very weak demand at these tips auctions. The last tips auction that we covered also had weak demand. And we'll get to what the yield curve is signifying in a second. Here's the 10-year break-even inflation rate. Of course, yesterday we had Trump announce some new sanctions on two of Russia's largest oil producers. That has sent crude oil prices 10-11% higher just over the past 2 days alone. Now, generally, that ends up translating to higher inflation. And of course, that is what the video this morning was about, how higher inflation from a higher oil price could actually cause significant trouble for the bond market. I would highly recommend going and watching that if you have not seen it already. Now, of course, there's a question about how durable this move in oil actually is. How important are these sanctions really? So here we're looking at the yield curve. And we can see that yields are down all across the curve going back to late August. The 30-year yield is down, the 10-year yield is down, the 5-year, 2-year, and 1-year, they're all down. And again, what that means with a bond is that the underlying price is up. They are inverse to each other with bonds. And again, this is called a bull flattener. So in pink, we can see that the spread between the 30-year yield and the 2-year yield has actually decreased. So the gap between the purple line and the red line has actually grown narrower. That is called a flattening of the yield curve. And we can see that it has flattened from 1.31% down to just 1.08%. And because bonds are rallying all across the curve, again, over the past 2 months or so, because bonds are rallying, this is called a bull flattener. And generally, this is not a good sign when it comes to economic growth. Generally, this is the bond market signifying some amount of economic uncertainty, flight to safety, and lower growth expectations. So in that way, it actually does make sense, this weak demand that we have been seeing at the various tips auctions, because again, remember, when you see weak demand at a tips auction, what that is signifying is the bond market is not very worried about inflation. Therefore, as demand weakens, you require a higher real yield. And again, that real yield being an interest rate above and beyond inflation. Remember, tips, the principal adjusts due to whatever inflation ends up being, and then you get that real yield on top. And so if the bond market was very, very worried about inflation, you would see a surge of demand into tips that would lower this real yield. But the opposite is also true. If you are worried about growth and you think that the US economy is in for a lower growth expectation over the next year, 2, 5 years, then of course you would see a weak demand at a tips auction, which again means that you require a higher real yield because of that weaker demand. So the bond market, whether it be through the yield curve kind of in its entirety or these various tips auction, is signifying that inflation is not really a concern to them. However, for the average American, I would point them to this chart, which is inflation, no matter how you measure it, core or headline, is at 3%. And the Fed's long run target is 2%, and they're cutting interest rates. You have assets at all time highs. You have gold ripping, doubling against the dollar. You do not see these kinds of moves in gold or moves down in the dollar. You do not see those kinds of moves when everything is fine, when inflation has been conquered. So I would just caution reading too much into the tips auctions. However, it should be noted that the yield curve over the past 2 months or so has flattened to some degree, and we are seeing that bull flattener, which again generally takes a lot of money to move the bond market. Of course, one of the largest markets in the world, the US bond market being the largest, arguably, it takes a lot of money to move this bond market. And when it's moving in a particular direction, it does pay to pay some attention to that movement. And of course, bull flattener indicating lower growth expectation. That does line up with the weak demand that we keep seeing at these tips auctions. However, gold has doubled basically versus the dollar over the past 2.5 years. You do not see gold go vertical like that when inflation is conquered. And of course, the Fed is cutting interest rates with inflation at 3%, and assets, whether it's home prices, stocks, or gold, are at all-time highs. And the Fed continues to cut interest rates. Of course, tomorrow we have CPI, so we'll stay tuned for that. But anyways, hopefully that was helpful, and I'll catch you in the next one.